Do you know that having credit or having access to credit or being able to get credit when you need it is absolutely essential to almost every individual in the United States, as well as, and possibly more importantly, is essential to almost every business in the United States, including, yes, including the biggest company in the world, market cap wise, Apple. Apple uses credit all the time, and even as recently as August, raised more debt through bonds that they're doing. And we're going to talk about that and also how much cash they really have and why they keep raising debt with that. Everybody, I've got a little presentation here I'm going to do. We're going to talk about the biggest company in the world, market cap wise, Apple, arguably the most successful company to ever exist in terms of, you know, all the iPhones, the most top selling product ever in the world, the iPhone. We're going to talk about Apple and all of the credit that they continually access and all the debt that they have combined with the cash positions that they have. And we're also going to talk about good debt versus bad debt and how the wealthiest use credit, everybody, and how and why they use credit. I've got a presentation here. It's going to be a little bit of time, but we're going to talk about that. Everybody, I work with people and businesses, and we're actually doing a lot of 0% credit right now. So if you're interested in 0% credit and, you know, maybe why it might be of use to you, I got this presentation here for you, and we're going to jump right in, okay? All right, so everybody, my name is John. I've done videos here on YouTube. I've done a lot of videos on investing. I actually started doing videos on credit years ago because I've got a background with online marketing in the mortgage space. Actually, processed tons of applications, 1 million applications between mortgage and credit applications over many years and years ago, and just got started talking about that, and then really did a lot of videos on investing. But we're going to go ahead and hop into this presentation right now. We're going to talk about all these things, like I said. Apple, why you know, some of the wealthiest people in the world use debt and credit. And then we're also going to talk about good debt versus bad debt. And then also, if you're somebody that is very interested, or you're a person or you're a business that's very interested in getting something like 0% credit, we're going to talk about different things that you can actually do with that if you don't already have a business, or if you're looking to actually get into, you know, raising some credit at 0% and getting into, you know, figuring out what to do with that credit in terms of using it as good debt to you know, launch a business or launch real estate. Okay. All right. So without further ado, we're going to go ahead and hop into this presentation that I put together for you. Okay, here you go. So super simple graphic right here. As you can see, good debt versus bad debt. You know, there's a lot of fancy images that I could use, but I think the simplest is really the one to do. Good debt equals you take the debt and you know, that whatever it is that you put that debt into, you invest that debt into something, and that something actually goes up. So that is actually good debt, right? So then there's the actual cost of you know, the cost of debt, and you know, if the value of whatever it is that you're purchasing with the debt actually goes up, or it starts to produce revenue, and then you then pay that capital back, and then you pay the cost of that capital back, and you then have an asset and it's gone up, that's good debt. Bad debt doesn't necessarily mean a car, because especially in this, you know, crazy economy that we've had since, you know, since 2020, a lot of, you know, vehicles have gone up a lot in value, oddly enough. Certainly, you know, the used car market. Anyway, so the value goes down, no revenues. Bad debt equals, obviously, you know, you invest that capital into something and the value goes down, or there's actually no revenues from it, or you're investing in things like, you know, just merchandise, not necessarily merchandise, but just you're investing in things and just consumer spending, where there's really there's no revenues resulting from it, or no appreciation from it. Okay, so if you take a look at it, I'm gonna actually have to put my glasses on to actually read this a little bit better, but you know, here's a little image, and we're not going to really get into the actual products, but I do have this image just so you can see for an example. You know, we're listing you know, good debt as, you know, mortgage, because it's typically very low, and it's, you know, that mortgage is tied to what normally is an appreciating asset. At the time of this recording, here it is, we're in the fall of 2022, and interest rates have come up a lot, and real estate is, you know, gone from going crazy in the U.S. to, you know, it's starting to go down a little bit, and we'll see how much longer it does that. Bad debt is obviously credit cards. I think auto loan is questionable, but credit cards is bad debt, and then also things like cash advances and very high interest short-term loans. And they're listing debt consolidation of home equity as good debt because they're actually, sometimes debt consolidation, you're refinancing debt at a lower rate. But for the purpose of this presentation, we're actually going to talk about good use of debt versus a bad use of debt, right? So a good use of debt is an investment using money that is not yours, other people's money, that yields a positive return after the cost of money, after the interest cost. This creates an asset for you, whether that asset is an appreciating asset and it's just, the asset goes up in value, or, more importantly, you're actually taking that debt and you're investing in something that then creates revenues for you. And let's say those revenues didn't exist for you before, whether that be a completely new stream of income, or, a completely new, piece of real estate that's a rental property or something like that. Bad use of debt, using the debt for consumer spending, stuff, or bad investments that costs you more money and turns into a liability, right? So very, very super, super simple. Going back to this, good debt, you invest it, it goes up or creates new revenues. Bad debt, value goes down, no revenues, or just irresponsible consumer spending. Okay, so, one of the spirits of this presentation is that we are speaking with a lot of folks and really just dealing with folks that either have a business or don't have a business, or they're interested in getting credit at 0%, right? It's something that's pretty we talk to a lot of people about right now, right? So kind of the spirit of I should say part of the spirit of this presentation is really talking about how you can go get 0%. And if you want to get credit at 0% for large sums, you typically have to then have an LLC and then get larger sums. But you can still, as an individual, even get credit at 0%. It's just typically not going to be as high amount of that you can borrow as you could if you actually have an LLC or a business, or you're able to kind of start one and then even get higher amounts even on a brand new business, right? But the point of it is pretty easy. So if you're borrowing credit at 0%. All you have to do is make 1% on that capital. If you get a 1% return on your capital, you've actually made money, right? So that's the beauty of getting credit at 0%, is that you basically have a very low bar to actually have a return. And that low bar is either, make 1% or, don't lose money. And I realize that that's easier said than done. And a lot of people, a lot of businesses fail. And it's not exactly a walk in the park to invest in something or start something or create something that that doesn't necessarily lose money. But at the same time, it still is a pretty low bar, and it is very attractive for a lot of businesses and a lot of people to borrow at 0%. So we're going to cover a bunch of ways, why debt is good and how some of the wealthiest people use it, right? So in terms of raising debt and credit. The wealthiest always use debt to save on taxes and compound their wealth more quickly, right? So these are kind of key points of good debt or good uses of debt, right? So we got some wealthy people. What I'm also going to do is I've got like I'm going to go to investor.gov and I'm going to show you an investment calculator. Let's just say you're someone who sold a business or came upon some wealth, and I want to show the difference between actually selling some of those assets, over a 20-year time frame, and then having to pay capital gains taxes versus taking something like a margin loan to actually, use some of that money for things that you want. Another reason, another good use of it is debt is tax-free. So there's no tax-free. And the spirit of my statement on investor.gov is that you can, like I said, if you have assets in a stock account, you can go get a margin loan and then, borrow against your own assets to go purchase something, as opposed to selling those assets and then paying taxes on it, and that money would be gone, right? So debt is tax-free, and interest cost is an expense, which creates a write-off for your business. So, you not only is it tax-free, but then any interest cost can be written off on your business or your personal taxes. Number 3, it is used to grow wealth more quickly. If you invest in a business or other investment and achieve a rate of return which is higher than the cost of that debt. Obviously, in in the example of 0%. If you achieve 1%, return on that, you're actually beating that 0%, right? You limit your own risk. Use other people's money to limit risk to your own capital. This can increase your return on a good investment as you can use less of your own capital. So obviously, like, let's say, for example, you're doing, you're involved in a real estate deal. I mean, you take some of the people out there that do different sorts of, business deals or real estate deals. Anytime they can use the less of their own money, the more ecstatic that they are, because they're using other people's money to then get a return that they can get back. I mean, it's really the case you'll see pretty much everywhere. Anytime people can use less of their own capital, they will try to do that. and I'm gonna show you that with respect to Apple here in just a couple of minutes, and how Apple, the biggest company in the world in terms of market capitalization, is consistently, continually, raising more debt. And they have debt, fairly high debt levels, and then also very, very high cash levels as well, right? And then another good use of debt is lower the interest of other higher interest debt you may have. That's really just debt consolidation. Like, even for me, I mean, I own some real estate, and always want to try to consolidate some of that credit card debt into some home equity debt if I can, where I can, so you can swap out those interest rates, those higher interest rates, for those lower interest rates. Okay, so now what we're going to do is we're going to go into Apple. Okay, we're gonna talk about Apple and what Apple does with credit. Okay, so as we start to talk about Apple, I want to talk. Here it is again. We're in the fall of 2022. We're in October, the month of October. And basically what this is Apple in August announced that their latest debt deal is about $6.5 billion in new bonds. Apple, following up record quarterly results tied to its robust iPhone sales, rolled out a 4-part bond deal. It's just debt. Bond deal on Monday to raise new debt in a deal that could reach $6.5 billion. So super simple. Now they're raising an additional $6.5 billion. Now, if we take a look at Apple, basically here they are on Yahoo Finance. We take a look at their balance sheet. Now, this is actually, here we are, it's October. I don't know why, but they're actually just showing the full years of 2021 so far, so they're not showing 2022 yet. But if you take a look at it, you can see that their total debt is about almost $125 billion, right? And then their net tangible assets, which they consider to be cash, used to be a lot higher. I don't know if you remember hearing about it in 2019, but Apple had, close to $100 billion in cash back in 2019, about $90.5 billion in cash. Now they got about $63 billion in cash, and that's, again, not even invested capital, which is down here. But if you take a look, they have their debt and they have their cash. Cash is so precious to have. So even the biggest company in the world, and not only the biggest company in the world in terms of market capitalization, but arguably the company that has sold a unit that is the most successfully selling unit ever in the history of our planet, which is the iPhone, they have massive debt levels, they have massive cash levels, and they continue to raise credit. Why? Because credit is essential. Raising new debt, raising new credit, always having credit that you need is essential really for any business. If it's essential for Apple, it's pretty much essential for or nearly essential for almost any business out there, right? So then we're going to talk a little bit more about Apple and their debt. So here's a quick look at Apple's liabilities and their debt. According to the latest report balance sheet, Apple had liabilities of $127.5 billion due within 12 months and liabilities of $155 billion due beyond 12 months. Offsetting this, it had $51 billion in cash and US $45 billion in receivables that were due within 12 months. So its liabilities total $186 billion more than the combination of its cash and short-term receivables. Since publicly traded Apple shares are worth a very impressive total 2.48, so 2.5 trillion, it seems unlikely this level of liabilities would be a major threat. However, we do think it's worth keeping up an eye on the balance sheet strength and may change over time. We use the two main ratios to inform us about debt levels relative to earnings. First is the net debt divided by earnings before interest, tax, depreciation, and amortization, or EBITDA. Well, the second is how many times its earnings before interest and taxes covers the interest expense. So we can kind of get into it, but the point is that that's Apple's. This is Apple's situation. As you can see, we're really just talking, about Apple and the concept of, how they are arguably the most successful company in the world and the biggest company in the world, and now how they're always getting new credit. They have existing debt. They have more cash than pretty much any entity in the world, I believe, and they're consistently raising credit because it is essential, really, for their business, and they have obviously, possibly one of the best businesses in the world, right? Okay, so next we're going to hop in and we're going to talk about the investor.gov calculator, compound interest calculator, when it comes to what wealthy people do with credit, okay? Okay, so this is just super simple compound interest calculator from investor.gov, as you can see. So what I'm doing is just a super simple illustration. For example, I think $5 million, is certainly obviously very high net worth, right? And it's a lot of money to a lot of people. There's some people, out there that, I don't know, maybe think it's not a lot of money, but, it certainly is really to any average person, right? So let's say you did actually come into something like 5 million, whether that be because you sold a business or you're, working for a large company and you got a lot of shares and you've had lots of appreciation. In any case, it is a fair number. And then what we're going to do is we're going to use the length of time of 20 years, which also is a fair number. Say here we are, it's 2022. Let's say, you were someone that, did well in the dot-com era and you sold out before 2000 and you had that 5 million invested, or you were part of a dot-com startup and were able to exit before the crash or something like that, right? So you got 20 years, and then we're going to use the estimated rate of 9.8%. The reason I'm using 9.8%, in case you don't know, if you look back at the S&P 500, the return of the S&P 500 for the last 90 years, on average, is 9.8%. That's a great figure to use, and if you had that, I shouldn't say if you, the most logical thing a person that would come into something like 5 million would do would be to have some very safe investments, and the majority of which would be, I would imagine, an ETF tied to the S&P 500 index, which you should expect, considering the last 90 years that's returned 9.8%, you should expect to earn about 9.8%, right? We compound it annually, and let's just say you don't take anything out of it, right? So in 20 years, you will have 32,435,000. So basically 32.5 million you would have if you didn't touch it at all, right? The point of this illustration is obviously you're going to need to touch the money. You're going to need to live. You're going to want to maybe buy something nice, something like that, a house, whatever. In any case, if you were to invest those assets over that period of 20 years, and you were to have to then sell the securities, right? Let's just say you'd have to use $1 million, right? You'd have to pay capital gains tax, and the capital gains tax is going to be, whatever the capital gains tax is at that time, and what your income level is. Let's just say it's 20%. So you're going to have to pay, let's say, 20% taxes. So let's say you had to take $1 million. So we're going to change this figure from 5 to 1, right? Because you're going to have to use $1 million. So if you're going to have to use $1 million, let's take this figure. So basically, that $1 million that you had to take out, that you had to then sell and use, right? And obviously there's going to be capital gains tax, and then you're of 20%, and then you're going to use the money, kind of thing. So that $1 million, just as a gross number, in 20 years, that $1 million would have been about 6.5 million. But let's just say, out of that $1 million, you had to actually pay tax on 200,000. So that 200,000 in 20 years. No, that's not right. Sorry. That 200,000 in 20 years is 1.3 million. So selling those invested assets and having to pay 200,000 in taxes just cost you $1.3 million over 20 years. So the point is what a wealthy person would do, or most of them, what they do, is they go and they have their investments over at Schwab, Charles Schwab, or they Robinhood, or M1 Finance, or Merrill Lynch, Merrill Edge. That's what I do, Merrill Edge, and they do what's called a margin loan. In fact, one of the things I do too is as an internet marketer, I have blueprints, and I have actually a blueprint on one of the easiest ways to get credit, which is actually through a margin loan. And the rates are a lot higher now, but for a while, it was both Robinhood and M1, which were at about 2.5%, borrowing money, from your stock accounts at about 2.5%. So as your assets get higher, the majority of these firms like Schwab and Merrill Edge, they actually lower their margin rates. But a lot of the wealthy actually use margin because it's a tax write-off and because there's no taxes and they don't have to sell the assets. It does get risky with your investments, especially in times like now. Here we are, it's the fall of 2022, and stock values are going down. And when that happens, your percentage equity goes down, so it becomes very risky to actually have margin. But as long as you can be responsible about it, you can actually use it, and it's more tax advantageous to actually use that margin as opposed to selling securities and then paying taxes on it. Okay? Okay, everybody, so the last thing that we're going to talk about is we're going to talk about if you as an individual, if you already have a business or if you don't have a business, in any case, you're looking, you're kind of scratching your head like, well, what am I going to do with the capital if I go and I get 0%? If I go get credit and go get credit at 0%, what am I going to do with that? Because you don't necessarily have a business, or you're kind of trying to figure out what you would do with that 0%. Well, we have a few ideas. Really super simple. And first off, I'm also kind of part of a community where lots of entrepreneurs are doing all sorts of different things, and you can kind of comment down below and I can tell you more about that. But basically, it's really two simple things that I'm actually doing with credit when I invest it. Number one is let's go to real estate. Super simple. So number one is real estate. And that's basically nowadays, if you wanted to, you could go and do Airbnb, right? It's not as, there's a lot of new lending out there. The reason I'm talking about this is because you could go invest, the credit into doing a real estate deal, and you could just do a standard traditional, long-term, unfurnished, go buy a property, whether it's with a partner or yourself, and do a long-term unfurnished kind of investment property transaction. And there's actually a lot of lenders now that do a new form of lending on a property like that. And it's called DSCR, which is debt service coverage ratio. So they don't even take your income. They'll basically take the projected rent of your investment property, and then they can lend on that. They'll have all their different ratios in terms of what they need to be, but it's your personal income doesn't factor in at all. So that's very, very, very appealing, especially when you need to actually raise more money for a real piece of property that you own. You could also do Airbnb. That's something that I do. In fact, you'll see a lot of videos that I have on my channel. I do talk about short-term rentals. I have two properties of my own here in Southern California. And one of them I do lots of different rentals with Airbnb, and VRBO, and then I have another a third in Orange County where there's an actually interest in it, and there's some Airbnb in there. Airbnb is kind of quietly becoming probably one of the top performing real estate kind of cash on cash assets, because the rental income can be really pretty high, and the activity is very high as well. But most it still is the most common is just to do standard long-term unfurnished, or things like multifamily, that sort of thing. The other thing, which is actually really rather exciting, is something that I'm doing now as well, and it's really let's just call it YouTube, right? And not necessarily like this where I'm doing a video and you're watching me talk and listen to my face, but I'm actually in a program where I do YouTube faceless channels, where it's just we have go get footage that's completely able to use, and we have teams that basically come up with the script ideas, write the script. Then you also have voiceover people, then you have video editors, and you have thumbnail makers, and then you have a channel manager. I think it's actually very exciting. I've been on the internet a long time, and I don't really see many ways to generate traffic that's as appealing and as attractive as as you can see with YouTube. And I don't really have the stats yet, or the revenue stats, to compare it to something like real estate, but I am very excited to actually put that together. So that'll certainly be a video down the road where you can compare, investing in something like, YouTube no face channels, versus real estate, because real estate is a great investment, but at the same time, a lot of times it's really it's kind of not the greatest margin, so it can be a really tough business to have, right? And if you can get the YouTube to work, it's kind of like the reverse. It's not really that high of a cost to get into, and then the way that you've got to be able to basically have a runway of, let's say, anywhere from 3 to 10 months to actually pay for the videos before you actually take off and start making revenue from it. And the beautiful thing about YouTube is you can you have a wide array of ways to make revenue. It could, just obviously there's, YouTube ad revenue, but you could also do affiliate marketing. You could also create your own product. There's lots of different, channels of revenue that you could have from just one YouTube channel. So that makes it very appealing. Again, it will have to be successful, and you will have to find a way to make it successful. But it is something that even I'm doing with respect to the credit that I raised, right? Okay, everybody, so there you go. So there is the presentation that we have for you. We talked about basically credit and how we're talking to and working with a lot of folks in doing 0% credit. What are the good uses and the bad uses of credit? What is the largest and arguably the most successful company in the world? Apple. What do they do with credit and debt? And how do they, continually, how are they continually raising debt? What do the wealthiest people do with it? Illustrations of what happens if you, have to sell some assets, versus taking a margin loan. Oh, and one more thing that I actually didn't show and I meant to show is to put into perspective how big and successful Apple really is. And if you think about the reality of again, them having 90 billion in cash, back in 2019, and having this debt levels of 100 billion. I wanted to do a quick illustration, and I know this is the end of the video, but I wanted to do it just to put things in perspective for you. Personally, I'm actually very fascinated by the GDP of all these different countries, and the reality of big tech, in the US, and how big these companies really are. If you look at like just how massive they are, and how much revenues like Apple has, and when they do, quarterly revenues of over 100 billion or close to 100 billion, some of these companies are getting close to $1 trillion in sales, right? But if you take a look at it and really how it compares to countries, so I wanted to take a look and see, obviously, Apple's got debt of over 100 billion, so between 100 and 200 billion, and they now have, quarterly revenues of close to 100 billion, right? So you take a look at the actual entire GDP of a country at that $200 billion mark. And that's just what's fascinating to me. You think about, like, these companies in our country are these big. They're just massive, and they're just larger than some of the largest economies in the world, right? You say, okay, that first country's got a GDP of 200 billion is Greece. Then you got New Zealand at 204, Peru, Romania, Czech Republic, Portugal, Vietnam, Egypt, Bangladesh, Finland at 252, Chile 277, Pakistan, Philippines, Colombia, Malaysia, Singapore, Ireland, Hong Kong at 341. Really is fascinating, all the way up to the first $1 trillion company that we're seeing, $1 trillion GDP of Indonesia. It's just fascinating to me that some of these large tech companies are, and this is GDP, right? You figure GDP is output of the entire country. That doesn't take into account gross earnings, and it doesn't even take into account tax revenues. You'd have to be generous and multiply 0.3 to each of that. So 0.3 times 0.3. It really is fascinating. Anyway, so I wanted to do that illustration for you to show you how similar, or how big really, Apple is, in terms of being, arguably the most successful company in the world, and the largest company in the world market cap wise relative to some of these other countries, and how they're rivaling the GDP of other countries, right? So there you go, everybody. Hopefully that's interesting. If you want to talk to me about some of the 0% credit, because we are talking to a lot of people and it's becoming really popular, go ahead and just leave a comment below. You can always email me as well. You might see this video from an email that I sent out, and you can just reply to that, or you can also email me SoCalJohnnyC@gmail, or just go ahead and leave a comment here. And if you like this content, if you want to hear more about credit or anything like repairing your credit fast or getting credit, anything like that, go ahead and let me know in the comments, and we can and I'll do more videos. Planning on doing videos around credit for the next several months. Okay, thanks and have a great one.